Welcome to the monthly 3-Edge View from the Edge for July 2024. I'm Fritz Folts, a Chief Investment Strategist here at 3-Edge, and joining me here once again today is Eric Biegeleisen, Director of Investment Research and Deputy Chief Investment Officer here at 3-Edge Asset Management. And today, as we do at the beginning of each month, Eric and I will provide our firm's most recent outlook for the global capital markets, which is based on our proprietary 3-Edge research model. So let's get started. And the one thing that is still true is that investors here in the U.S. are still waiting and attempting to handicap when exactly the Fed will begin to lower short-term interest rates. And Eric, I don't know about you, but I feel like we've been waiting for the Fed to begin to lower rates basically forever at this point. Now, recently we did get an interesting data point with the most recent jobs report, which was solid, very solid. However, the report did indicate that the unemployment rate had ticked up to 4.1%, which is still, that's a very low rate of unemployment, but it may be signaling a gradual softening in the U.S. labor market, and we know that the Fed is looking closely and tracking developments in the labor market as part of their calculations in terms of when they may be able to begin to cut. So, Eric, why don't you start us off here today by reviewing our 3-Edge asset class matrix. It shows our current outlook for the major asset classes and what may have changed since last month. So I'll hand it over to you.
Great. Thanks, Fritz. Yeah, no doubt investors have been trying to really ascertain when the Fed may begin the path of rate cuts, how many and when they might occur. We'll dive into that a little bit. You can see here in the asset class matrix, no arrows. So things are pretty steady as she goes here. You have the U.S., developed Asia, and India maintaining a positive outlook from our research. Europe, a bit more mixed. EM China, a bit more negative. Rates are more mixed. Credit, still a negative outlook. Short-term fixed income and cash, earning that attractive yield, while the Fed has not begun that rate cut cycle. Still looking fairly attractive as well. And hard assets, both gold and commodities, still having a favorable outlook. So we'll talk about some of the drivers of those things.
All right, great. So let's dig into all this, and let's begin with the equity asset classes, starting with U.S. equities.
Yeah, May was a strong month for U.S. equities. The U.S. equity market, as measured by the S&P 500, was up over 5%. You had another strong month in June, up over another 3.5%. So, it seems like investors have really settled in on the prospect for 2 interest rate cuts by year end, despite Fed Chair Powell and the team not necessarily indicating that. The market has a habit of doing that. Our research suggests that this market run-up is just very, very heavily behaviorally driven. So, the market is still heavily overvalued in the manner in which we measure it, and prices are moving up far beyond both sales and earnings. They continue to do so. So the potential for the market to do an about face and to do so quickly is definitely a concern we're definitely focused on. But in the near term, it feels like things can continue to move up from here.
All right, great. So let's shift attention to the ex-U.S. equity markets, beginning with European equities.
Yeah, the European Central Bank, or the ECB, announced its decision to lower interest rates at its last meeting. And the market is anticipating further cuts in the months ahead, though maybe slowly. This cut and future anticipated cuts, they operate with a lag. And therefore, while potentially that could be beneficial to the outlook for European equities in the months ahead, it does take some time for that to manifest itself more positively in our research. European equities, like the U.S., enjoyed a strong May, but did suffer a pullback in June. So for the time being, the outlook here does remain mixed.
All right. Let's shift our attention to Asia, Japanese equity market, where it does seem as though the big question, as it has been for a while, is the direction of the Japanese yen. So what are we seeing in Japanese equity markets?
Yeah, the overall model outlook is favorable, with positive contributions from investor behavior measures, tightening credit spreads, and our steepening yield curve measure for the region. And, while we favor an exposure here, we find that there's potentially limited downside for the Japanese yen, as it's now been hovering in that 160 yen to dollar region. And that's a level where just somewhat recently, the Bank of Japan was seen intervening in currency markets to shore up the yen. On top of this, you still have the potential for further interest rate increases by the BOJ as well, which would also potentially strengthen the yen. So unhedged and favorable on Japanese equities.
All right. How about emerging markets, including China? What's the model saying there?
Yeah, like European equities, Chinese equities had a nice May but struggled in June as fears, that the potential for a rebound here may not be forthcoming. Something that we had talked about just a month ago. The weak domestic consumer spending, potentially due to that stagnant Chinese property sector, just continue to weigh very negatively on the outlook here in the near term. That said, the potential for a shorter term rebound does remain as Chinese equities are nearing a shorter term oversold position as we measure it. Broader emerging market equities exposure may fare better with less volatility than a direct China investment, but it's unlikely to look too favorable while China maintains this negative outlook overall.
All right. And let's take a look at India now that we are on the other, we're through their election cycle. What are we seeing there?
Yeah, India's equity markets definitely seem to have found their footing after that rocky election, with equities up over 5% in June. Our research indicates positive outlook from largely positive investor psychology measures as well as market momentum. Still overvalued by our measure, like the U.S., but these positive factors, along with the potential for the Reserve Bank of India, India's central bank, to lower short-term interest rates in the near term, could provide this additional boost to the outlook. So still positive here.
All right. Let's shift gears and look at the bond market now and the current interest rate environment, starting with the U.S. Treasury market. What are we seeing there?
Yeah, U.S. Treasuries, they've struggled so far in 2024 here. While the 10-year yield peaked a few months ago and has come back somewhat, the path of continued interest rate declines is not certain. So it's hard to get too excited about it. Shorter maturities that continue to provide more attractive yields, that just, in our opinion, remains a better risk-adjusted way to gain access on the yield curve.
And the corporate bond market or the credit markets, what is the model seeing there?
Yeah, the potential for, an economic slowdown does not seem priced in at all to credit spreads, which remain near these historic tight levels. So again, that risk-reward trade-off, like longer duration treasuries versus shorter term, you go stepping out into credit, the risk-reward trade-off just does not seem like it's there. It's warranted necessarily at this time.
All right. So now we'll go into another area, another asset class, which we refer to, which is the hard assets. That includes both gold and commodities. And why don't we begin with what the model is telling us about the outlook for gold at this point?
Yeah, gold's had a strong year so far in 2024. It's benefited from positive investor psychology measures, momentum measures, an increase in central bank purchases of gold. Rising political tensions are generally helpful to gold. And we've seen short covering as a result of the price running up more, which is also beneficial. So additionally, you have this prospect of a decline in real, that is inflation-adjusted U.S. interest rates, and that could also be a further support for gains in the price of gold. So the outlook remains favorable here.
Yeah, I did an interview recently, in fact, last week, and I couldn't believe all the bullet points in favor of gold right now. They stack up quite well, so we'll see how that goes. Let's shift gears and look at commodities, excuse me, and see what the model is telling us about commodities at this point.
Yeah, based on our research, the general outlook for commodities has maintained its somewhat positive outlook. You have continuing geopolitical conflicts and the rising price of gold together, bode well for the commodities outlook. Should the value of the U.S. dollar decline, perhaps as the Fed prepares to lower rates, dollar-denominated assets like commodities may benefit from that. So it's still positive.
All right, great. I think that's a wrap. Thank you for giving us the outlook here in July. Just to summarize, the model continues to suggest favorable environment for equities and hard assets, U.S., Japanese, and Indian equities, as well as gold and commodities. But as you mentioned, in case of U.S. equities anyway, we certainly remain vigilant, in terms of any potential event that could trigger a correction here in the U.S. equity markets. So that will do it for Eric and me for this month's View from the Edge. Now, if you would like to get the full monthly View from the Edge newsletter in hard copy, that's available on our website, and that's at 3edgeam.com. Meanwhile, Steve Cucchiaro and I will be back next week with the latest edition of the 3 Edge Week in Review. And as a reminder, our entire library of video content is also available on our 3 Edge YouTube channel. And if you think that someone might benefit from the videos, please feel free to share them. So on behalf of Eric and everyone here at 3Edge, thanks for listening.